Everything you thought you knew about free markets is a lie. Everything they taught you in economics class is obsolete. Everything the financial media tells you about supply and demand determining prices is a fiction designed to keep you passive while the greatest manipulation in human history unfolds before your eyes. For decades, we have documented the suppression of precious metals prices. We have tracked the paper manipulation on the COMEX. We have exposed the bullion banks and their naked short-selling schemes. We have proven beyond any reasonable doubt that silver and gold were artificially held down to protect the fiat currency system. But something has changed. Something fundamental has shifted in the machinery of manipulation. The direction of the rigging has reversed. The same government that spent 40 years suppressing precious metals prices is now rigging them upward. Not because they have suddenly discovered the virtues of sound money, not because they have repented of their manipulation sins, but because they have no choice. The system is so broken, the debts are so large, the currency is so debased, that they must now inflate everything, including precious metals, to prevent a deflationary collapse that would destroy the banking system overnight. Ladies and gentlemen, this is Silver Storm Daily, and tonight I am going to expose the most closely guarded secret in modern finance. The free market is over. The U.S. government is now rigging prices upward across every asset class, including gold and silver. And understanding why they are doing this is the key to understanding where prices are headed next. Let me start with the evidence because this claim requires proof. The assertion that the government is rigging prices upward sounds like it should be bullish for precious metals holders. And it is bullish. Extraordinarily bullish. But it is also terrifying because it reveals just how desperate the situation has become. When governments start rigging markets upward rather than allowing natural price discovery, it means they have lost control. It means the underlying fundamentals are so broken that they cannot allow true prices to be discovered. It means we are in the endgame of the fiat currency experiment. The first piece of evidence is the Federal Reserve's balance sheet. Before 2008, the Fed's balance sheet was approximately $800 billion. Today, it exceeds $8 trillion. That is a tenfold increase. Where did those $8 trillion go? They went into financial assets, treasuries, mortgage-backed securities, and through various mechanisms, equities, and commodities. The Fed does not officially buy stocks or gold directly, but they buy assets from primary dealers who use the liquidity to buy other assets. The money flows through the system and lifts all prices. This is not a free market. This is a market where the central bank is the largest buyer. The second piece of evidence is the Treasury's Exchange Stabilization Fund. The ESF was created in 1934 with the specific mandate to intervene in currency and credit markets. The fund operates in secret. It does not report its activities to Congress. It has unlimited authority to buy or sell currencies, securities, and other financial instruments. For decades, analysts have suspected that the ESF was used to suppress gold prices. The evidence suggested coordinated selling at key moments to protect the dollar, but the recent price action suggests a policy reversal. The ESF appears to be supporting gold prices rather than suppressing them. The patterns of intervention have changed. The sudden buying that appears at key support levels. The mysterious bids that materialize when prices threaten to break down. The fingerprints of government intervention are visible, but the direction has reversed. The third piece of evidence is the behavior of the bullion banks. For 40 years, the bullion banks ran massive short positions in gold and silver. They sold paper that was not backed by physical metal. They used their unlimited credit to suppress prices whenever they rose too quickly. This pattern was so consistent that it became predictable. We could set our watches by the attacks, but in recent months, the pattern has broken. The commitment of traders data shows that the commercial category, which includes the bullion banks, has reduced its net short position to levels not seen in over a decade. Some analysts believe the commercials have actually flipped net long. The shorts are covering rather than adding. The manipulation machine that suppressed prices for decades is now running in reverse. The fourth piece of evidence is the Treasury's gold revaluation account. The U.S. Treasury officially values its gold holdings at $42.22 per ounce. This is the price that was set in 1973 and has never been updated. At current market prices above $5,000 per ounce, the Treasury's gold is worth approximately $600 billion more than the books show. There have been persistent rumors that the Treasury is preparing to revalue its gold holdings to market prices. This revaluation would add $600 billion to the Treasury's assets overnight, providing additional borrowing capacity without printing new money. A revaluation at even higher prices would provide even more capacity. The government has a direct financial incentive to see gold prices rise. They are not fighting the rally. They are encouraging it. The fifth piece of evidence is the coordination with foreign central banks. The Bank for International Settlements, which is the central bank of central banks, has been facilitating gold transactions at a pace that suggests coordinated accumulation rather than random trading. The gold lease rates, which reflect the cost of borrowing gold, have been persistently low despite the supply tightness visible in the physical market. This suggests that central banks are lending gold not to suppress prices but to facilitate orderly accumulation by allied central banks. The coordination is happening, but the objective has changed from suppression to elevation. When you aggregate all of this evidence, the conclusion is inescapable. The policy has reversed. The government that spent decades fighting gold and silver is now supporting them. The free market, where prices were determined by supply and demand, if it ever truly existed, is definitely over now. We are living in a managed market, where the government sets the direction and the traders follow. Now let me explain why the government reversed its policy, because understanding the why reveals where this is headed. The government did not suddenly discover the virtues of sound money. They did not have a moral awakening. They reversed the policy because they had no choice. The mathematics of the debt forced their hand. The United States government has accumulated over $37 trillion in debt. The annual deficit exceeds $2 trillion. The interest payments on the debt now exceed $1 trillion per year, consuming more than the defense budget. These numbers are beyond human comprehension. They are so large that the mind cannot process them. But the mathematics is simple. The debt is unpayable. There is no scenario in which the U.S. government repays $37 trillion in money that has the same purchasing power as the money that was borrowed. The only question is how the debt will be resolved. There are only three options. Option 1 is default. The government could announce that it will not honor its obligations. Bondholders would receive pennies on the dollar or nothing at all. This option is unthinkable because it would destroy the treasury market, which is the foundation of the global financial system. Every bank, pension fund, and insurance company holds treasury bonds as their safest assets. A default would trigger a cascade of failures that would make 2008 look like a minor correction. The government will not explicitly default. Option 2 is austerity. The government could cut spending and raise taxes to balance the budget and begin repaying the debt. This option is politically impossible. The spending cuts required would eliminate Social Security, Medicare, and most of the military. The tax increases required would crush the economy. No politician who proposed real austerity would survive the next election. The government will not embrace austerity. Option 3 is inflation. The government could repay the debt in dollars that are worth less than the dollars that were borrowed. If the dollar loses 50% of its purchasing power, the real burden of the debt is cut in half. If the dollar loses 90% of its purchasing power, the debt becomes trivial. This option is politically feasible because inflation is a hidden tax. Most people do not understand it. They blame rising prices on greedy corporations rather than government policy. Inflation allows the government to default on its obligations without technically defaulting. The government has chosen option 3. They have committed to inflation. They have no other choice. And once you understand that inflation is the policy, everything else makes sense. The Fed's balance sheet expansion is designed to create inflation. The deficit spending is designed to create inflation. The support for asset prices is designed to prevent the deflationary crash that would derail the inflation policy. The reversal in precious metals manipulation is part of the inflation policy. Gold and silver rising validate the inflation thesis. They provide a release valve for the pressure building in the monetary system. They absorb some of the money printing without threatening the treasury market. The government is not rigging gold and silver prices upward because they want to help precious metals investors. They are rigging prices upward because rising gold and silver are less dangerous than the alternative. The alternative is a deflationary collapse that would bankrupt the banks, crash the stock market, and expose the insolvency that lies beneath the surface of the entire financial system. Given the choice between controlled inflation with rising precious metals and uncontrolled deflation with systemic collapse, the government chose inflation. We are the beneficiaries of that choice. Let me now explain how the upward rigging works in practice, because understanding the mechanism helps you anticipate the moves. The government does not simply place buy orders for gold and silver futures. That would be too obvious. That would be too easily tracked. Instead, the rigging works through multiple channels that provide deniability while achieving the desired effect. The first channel is interest rate policy. The Federal Reserve sets short-term interest rates. When rates are low, the opportunity cost of holding gold is low. When rates are high, holding gold means forgoing interest income. By keeping rates artificially low relative to inflation, the Fed makes gold and silver more attractive. The real interest rate, which is the nominal rate minus inflation, has been negative for years. Negative real rates are the most bullish possible environment for precious metals. The Fed is creating this environment deliberately. The second channel is quantitative easing. When the Fed buys bonds, it creates new money that enters the financial system. This money has to go somewhere. Much of it flows into financial assets, including commodities. The Fed may not buy gold directly, but the money they create eventually finds its way into gold markets. The correlation between the Fed's balance sheet and the gold price is strong and statistically significant. QE is gold price support by another name. The third channel is forward guidance. The Fed communicates its policy intentions to shape market expectations. When the Fed signals that rates will stay low for an extended period, investors adjust their portfolios accordingly. They buy gold because they expect low rates to persist. The Fed's words move markets as much as their actions. By guiding expectations toward perpetual easy money, they support gold prices without directly intervening. The fourth channel is regulatory forbearance. The bullion banks that used to suppress prices were able to do so because regulators looked the other way. The concentrated short positions that the banks ran would have been illegal in any other market. Position limits existed but were never enforced. The regulatory capture was complete. But the same regulatory capture can work in reverse. If the regulators wanted to end the suppression, they could simply enforce the rules that already exist. The reduced short positions in the commitment of traders data suggest that the regulators have changed their approach. They are no longer facilitating suppression. They may be actively discouraging it. The fifth channel is direct intervention through the ESF. The Exchange Stabilization Fund has the legal authority to buy or sell gold at any time for any reason without reporting to Congress. The fund's activities are classified. We cannot prove that the ESF is buying gold, but we can observe the price patterns that are consistent with intervention. The sudden appearance of bids at key support levels, the mysterious buying that materializes during overnight sessions. The patterns have changed in ways that suggest the ESF has reversed its stance. The sixth channel is coordination with allied central banks. The United States does not act alone. The G7 central banks coordinate their policies through regular meetings and constant communication. If the policy has shifted from suppression to support, the shift would be coordinated across all major central banks. The evidence suggests this is happening. European central banks have stopped selling gold. Asian central banks are actively buying. The gold that used to flow from west to east through central bank sales is now flowing from east to west through central bank purchases. The coordination is global. Through these 6 channels, the government rigs prices upward without leaving obvious fingerprints. The rigging is plausibly deniable. The financial media can continue to pretend that markets are free while the managed price appreciation continues. The cover story holds as long as people do not look too closely. Now let me explain what this means for the future, because understanding the policy reveals the trajectory. If the government is committed to inflation, and if rising precious metals prices are part of the inflation policy, then the current prices are not the top. They are not even close to the top. The top arrives when the inflation has accomplished its purpose of eroding the real value of the debt. That process has barely begun. The national debt is $37 trillion. The interest payments are $1 trillion per year. For the inflation policy to succeed, the real burden of this debt must be dramatically reduced. If inflation runs at 10% per year, the real value of the debt declines by 10% annually. After 7 years of 10% inflation, the real burden is cut in half. After 15 years, it is cut by 75%. The debt becomes manageable without default or austerity. But 10% official inflation would mean much higher actual inflation in commodities and precious metals. Official inflation is systematically understated through hedonic adjustments, substitution effects, and geometric weighting. If official inflation runs at 10%, real-world inflation in things that matter, like food, energy, and precious metals, will run at 15 to 20% or higher. Apply this inflation rate to precious metals over the next decade, and the price targets become extraordinary. Gold at $5,000 today, compounding at 15% annually, reaches $20,000 in 10 years. Silver at $90 today, compounding at 20% annually, reflecting its greater volatility and industrial demand, reaches $550 in 10 years. These numbers seem fantastic from the current vantage point, but they are the mathematical output of the policy the government has chosen. The government cannot announce these targets. They cannot admit that they are deliberately debasing the currency. They cannot acknowledge that the free market is over and they are rigging prices. The admission would cause a panic that would accelerate the very dynamics they are trying to manage. So they maintain the fiction of free markets while engineering the outcomes they need. They let the prices rise at a pace that is fast enough to erode the debt, but slow enough to avoid a currency crisis. They manage the ascent. This managed ascent is what we are experiencing right now. The precious metals prices are rising, but they are rising in an orderly fashion. The corrections are contained. The breakouts are allowed. The overall trend is up. This is not a free market discovering prices through the interaction of supply and demand. This is a managed market where the government sets the direction and the magnitude of the moves. Let me now address what this means for the manipulation narrative that we have built over years of analysis. For decades, we have correctly identified that precious metals prices were manipulated downward. We have exposed the bullion banks. We have documented the paper schemes. We have shown how the COMEX was used to set artificial prices that did not reflect physical supply and demand. This analysis was correct. The manipulation was real. The suppression happened. But we must now update our analysis to reflect the policy reversal. The manipulation has not ended. The market is not suddenly free. The manipulation has simply changed direction. The same mechanisms that were used to suppress prices are now being used to support prices. The same entities that were short are now long or neutral. The same coordination that pushed prices down is now pushing prices up. This updated understanding does not invalidate our previous analysis. It builds on it. The skills we developed in tracking the suppression are the same skills we need to track the elevation. The patterns we learned to recognize when prices were being pushed down are inverted versions of the patterns we now see as prices are being pushed up. The manipulation expertise transfers to the new regime. The key insight is that neither the suppression nor the elevation reflects true market prices. The true price of silver, determined by actual physical supply and demand, has been unknown for decades. It was artificially suppressed before, and it may be artificially elevated now. The managed price is higher than the suppressed price was, but it may still be lower than the true free market price would be. Or it may be higher. We simply cannot know because there is no free market to discover the true price. This uncertainty does not matter for practical investment purposes. What matters is the direction of the managed price. And the direction is unmistakably up. The government needs inflation. They need asset prices to rise. They need precious metals to rise as part of the overall inflation policy. They will continue to support prices until the inflation has accomplished its purpose. That process will take years, possibly a decade or more. Throughout that period, the direction is up. Now let me explain the risks of the upward rigging because nothing in finance is without risk. The government's ability to rig prices upward depends on their ability to maintain confidence in the system. If confidence collapses, the managed descent becomes an uncontrolled explosion. The risks are real. The first risk is a loss of control over the pace of inflation. The government wants inflation at 10%, enough to erode the debt, but not so much that it causes social unrest. But inflation is not a precision tool. It is a fire that can spread beyond the intended boundaries. If people lose confidence in the currency, the velocity of money can spike as everyone tries to convert paper to real assets simultaneously. This velocity spike causes prices to rise faster than the government intended. The managed descent becomes a parabolic blow-off. Gold and silver would skyrocket in this scenario, but the social chaos would be severe. The second risk is a geopolitical shock that disrupts the coordination. The upward rigging depends on cooperation among the major central banks. If that cooperation breaks down, if one major player defects from the managed approach, the entire edifice could crumble. China's potential gold revelation is one such risk. If China announces gold reserves far larger than expected, it would expose the weakness of Western reserves and potentially trigger a rush to gold that the government could not control. The third risk is a derivatives failure that exposes the paper leverage. The gold and silver markets include vast quantities of paper claims that are not backed by physical metal. If a major counterparty fails to deliver, if the paper claims are exposed as worthless, confidence in the managed system would collapse. The price would spike initially as everyone rushes to secure physical metal, but the financial chaos could trigger broader systemic failures. The fourth risk is political change that reverses the policy. The current policy of managed inflation with rising precious metals reflects the consensus of the financial establishment, but political power can shift. A new administration with different priorities could attempt to suppress precious metals again. This attempt would likely fail given the current fundamentals, but it could cause significant volatility in the transition. The fifth risk is public awakening that overwhelms the system. The managed descent depends on most people not understanding what is happening. If too many people recognize that the market is rigged and rush to buy physical precious metals, the available supply would be overwhelmed. The premiums would explode. The paper and physical markets would diverge completely. The government would lose control of the price even as they tried to support it. Each of these risks could manifest at any time. The managed ascent is not guaranteed to proceed smoothly. There will be volatility. There will be corrections. There will be moments of fear when it seems like the policy has failed. These moments are opportunities for those who understand the underlying dynamics. The policy has not failed. The direction has not changed. The managed ascent continues. Let me now address what this analysis means for your investment strategy, because understanding the rigged market changes how you should approach it. The first implication is that traditional technical analysis is less useful than it used to be. Technical analysis assumes that prices reflect the aggregate decisions of market participants. In a free market, support and resistance levels emerge from the interaction of buyers and sellers. But in a rigged market, support and resistance levels are set by the manipulators. The government decides where prices should be and uses their tools to achieve those prices. Technical patterns still provide some information, but they must be interpreted through the lens of understanding who is really in control. The second implication is that fundamental analysis matters more than ever. The fundamentals of supply and demand in the physical market remain the ultimate constraint on the manipulation. The government can rig paper prices, but they cannot create physical silver. They cannot conjure gold from thin air. The physical shortage that underlies the current rally is real. The industrial demand for silver is real. The central bank accumulation of gold is real. These fundamentals set the direction that the manipulation must follow. The government is rigging prices upward because the fundamentals demand it. They could not suppress prices indefinitely because the physical shortage made suppression unsustainable. The third implication is that the safest position is physical metal. In a rigged market, paper claims are vulnerable. If the manipulation shifts or breaks down, paper holders could find themselves on the wrong side of the trade. Physical metal is outside the manipulation system. It cannot be rehypothecated, leased, or swapped. It sits in your possession regardless of what happens in the paper markets. The rigged market makes physical ownership more important, not less. The fourth implication is that you should not fight the direction. In the old suppression regime, buying precious metals meant betting against the government. The government had infinite resources to suppress prices. Fighting them was difficult and required patience measured in decades. In the new elevation regime, buying precious metals means betting with the government. The government has the same infinite resources, but now they are pushing prices up rather than down. You are on the same side as the manipulators. This is a much easier position to be in. The fifth implication is that price targets need to reflect the managed nature of the market. The government will allow prices to rise, but will try to manage the pace. They will intervene to prevent crashes that threaten confidence. They will also intervene to prevent spikes that threaten currency stability. The price path will be more orderly than a true free market would be. Expect steady appreciation with contained corrections rather than wild swings. Let me now give you my forward outlook based on the understanding that the market is rigged upward. The government needs approximately 10 years of sustained inflation to make the debt manageable. Throughout this period, they will support asset prices, including precious metals. The trajectory is higher with managed volatility along the way. For gold, my target over the next 2 years is $7,500 per ounce. This represents approximately 50% appreciation from current levels. The pace is consistent with 15% annual returns, which is aggressive but not so aggressive that it threatens currency stability. The government will allow this pace. They will intervene to maintain it. For silver, my target over the next 2 years is $150 per ounce. Silver's greater volatility and industrial demand justify a higher percentage return than gold. The gold-silver ratio will compress from current levels as silver outperforms. $150 silver with $7,500 gold represents a ratio of 50 to 1, still elevated by historical standards but lower than current levels. For the mining stocks, the outlook is even more bullish. The miners provide leverage to the underlying metal prices. A 50% increase in gold translates to a 100 to 200% increase in miner earnings, and potentially a 300% or greater increase in stock prices. The manipulation that suppressed metal prices also suppressed miner valuations. The reversal in manipulation creates a double tailwind for the miners. These targets may seem aggressive, but they are conservative relative to what the government needs to accomplish. They need to erode $37 trillion of debt. They need inflation to run for years. They need asset prices, including precious metals, to rise dramatically. My targets represent the minimum the government requires, not the maximum the market could achieve. Let me close with perspective on what the end of the free market means for our understanding of finance and economics. For generations, we have been taught that free markets are the best mechanism for allocating resources, that prices determined by supply and demand are efficient, that government intervention distorts markets and creates inefficiency. These teachings were always more aspirational than descriptive. Markets have never been truly free. Governments have always intervened. But the scale of the current intervention is unprecedented. The admission that prices are managed rather than discovered is a fundamental break from the ideology that has dominated economics for decades. This break has consequences that extend beyond investment strategy. It changes how we should think about value. It changes how we should think about money. It changes how we should think about the relationship between individuals and the state. If prices are managed, then the price of your labor is managed. The price of your savings is managed. The price of your future is managed. You are not a participant in a free market making autonomous decisions. You are a subject in a managed economy making decisions within constraints that are set by others. The precious metals investor has always understood this to some degree. We have always known that the monetary system is rigged against savers. We have always known that inflation is a hidden tax. We have always known that the government's promises about the dollar were lies, but we thought we were fighting against the manipulation. We thought that by buying gold and silver, we were opting out of the managed system. We were asserting our autonomy against the controllers. The revelation that the government is now rigging prices upward complicates this narrative. We are no longer fighting against the manipulation. We are benefiting from it. The same mechanisms that oppressed us for decades are now enriching us. This is an uncomfortable position for those of us who value freedom and resent manipulation. We are winning, but we are winning because the manipulators have changed sides, not because we defeated them. Perhaps the lesson is that in a rigged market, the goal is not to defeat the manipulators, but to understand them, to anticipate their moves, to position yourself on the right side of their interventions. The free market idealist in us may wish for a world where prices are determined fairly by supply and demand. But the practical investor in us must deal with the world as it is, not as we wish it were. The world as it is includes a government that is rigging prices upward. The practical response is to hold physical precious metals and let the manipulation work in our favor. The free market is over. The government is rigging prices upward. This is not a conspiracy theory. It is a documented reality supported by evidence from multiple sources. The evidence includes the Fed's balance sheet, the ESF's activities, the bullion bank positioning, the Treasury's gold account, and the coordination with foreign central banks. The policy has reversed because the mathematics of the debt required it. The government needs inflation, they need rising asset prices, they need precious metals to rise as part of the overall inflation strategy. For those who hold physical gold and silver, this is extraordinarily bullish. You are positioned on the right side of the manipulation. You are aligned with the policy. You will benefit from the managed descent that the government requires. The targets of $7,500 gold and $150 silver are achievable within 2 years. Higher targets are achievable over longer time frames as the inflation continues. This has been Silver Storm Daily. The free market is over. The U.S. government is rigging prices upward. The evidence is clear. The policy is unmistakable. The trajectory is higher. Hold your precious metals. Buy more if you can. The manipulation that oppressed us for decades is now lifting us. Let it carry your wealth higher. We are in the storm, but for once the wind is at our backs. Like, subscribe, and share this video with everyone who needs to understand that the game has changed. The manipulators are now on our side. The direction is up. The future belongs to those who hold real money in a world of managed fiat. See you in the next report.